If you thought international trade wars would only matter to factories and politicians, think again. When the US and Canada impose tariffs, adjust import rules, or pull out of trade talk, it shows up at your grocery store, in your car payment, and in your job security. I'm Thuc, your money guy, and today we're going to dive deep into the 2025 US-Canada trade war. What triggered it, what the numbers said, and how it will impact your money in very real ways. Here's the backstory. Canada is one of the US biggest trading partners. Trillions of dollars in goods flow back and forth. But in 2025, tensions exploded. For example, on October 25, the US announced a 10% tariff hike on certain Canadian imports after a public dispute over a trade advertisement aired by Ontario. Earlier in the year, Canadians were hit by US tariffs on steel, aluminum, and Canada responded with $30 billion tariffs. What this means is simple. Goods cost more, trade slows, companies hesitate, and you feel it. Here's the reality. When Canada takes 20% or more of its GDP exposure to US trade, any shock ripples into every household. To understand this, we have to understand why Canada is vulnerable. Canada's economy is deeply tied to the US. Roughly 1/5 of its GDP is exposed through exports and imports. Compound that with sectors like autos, steel, aluminum, agriculture, and you have risk. The trade war scenario isn't just about tariffs. It's about supply chain disruption, job losses, and rising costs. For example, Reuters reported that the new US tariffs threatened to derail Canada's economic recovery, citing unemployment potentially rising and growth stalling. So while Canada might usually shrug off some global shocks, this one hits home because of the scale and the interconnection. When a trade partner grabs one end of the chain, the other end wobbles. That chain goes to your paycheck or your fridge. So how is it actually affecting regular Canadians? Here are the 6 real-life. Impact number 1, higher consumer prices. Tariffs on imports mean higher input costs for manufacturers, which often get passed on to you. In the US, some estimates say tariffs add $1,300 USD per household annually. Expect similar or worse in Canada when trade stops or supply gets constrained. Impact number 2, jobs and layoffs industries subject to tariffs. Steel, aluminum, autos, parts may reduce production or lay off workers. Reuters flagged that Canada could see job losses and slowing growth, especially in manufacturing hubs. If you are working in those sectors, you gotta pay attention. Impact number 3, export-dependent small businesses. If you own or work in a business that sells cross-border or uses imported parts, your costs may rise, margins shrink, and you may pass on costs or cut back jobs. Impact 4, weaker economic growth means less wage growth. When growth stalls, governments collect less tax, companies invest less, and wages stagnate. The trade war could cost Canada 2 years of growth if sustained. Impact 5, doubled up prices on cars, goods. For example, tariffs on steel and aluminum affect car manufacturing. One report, a 25% steel tariff plus 10% aluminum tariff could add $1,500 USD to the cost of a car. If you're buying a vehicle, that may show up. Impact number 6, real estate and regional risk. Places dependent on export jobs or manufacturing like Windsor, Sarnia, Sudbury may face slowdowns. If jobs go, housing demand weakens, and you could face softer markets. So whether you rent, buy, or invest, trade matters. In short, trade wars may start with big companies but end in your living room. So where are we today and where could this go? The US declared in October 25 that it would terminate trade talks with Canada amid the tariff mess. Canada responded by removing some counter tariffs, September 1st, 2025, but steel, aluminum, and autos remain hit. Economists expect that unless trade normalizes, Canada could lose 2.5 to 3% of GDP over time. For the average Canadian household, the cost could be $1,900 Canadians a year in extra cost or lost income. This means we are at the danger zone. If either side escalates or gets blocked, the human cost grows. So here are the strategies for you. For consumers, households, track your spending, grocery, appliances, cars. If you see prices rising faster than usual, it may be the trade war showing up. Build an emergency fund when growth slows. Job risk rises. Consider Canadian-made or local products. Supply chains under tariffs often favor domestic goods or face price shocks. For workers in vulnerable sectors, if you work in manufacturing, exporting, or rely on US-Canada trade, plan ahead. Upskill, diversify roles. Monitor local announcements. Job cuts often precede slower hiring. For property owners and investors, in regions that on manufacturing exports, consider slower growth scenarios. For rental property, slower job growth can reduce demand or slow rent growth. Adjust your expectations. For homeowners with high exposure export towns, consider how a downturn might affect your ability to refinance, sell, or sustain payments. For businesses, if you import-export, review supply chains, check tariff exposure, talk to your suppliers. Consider whether you can localize more or hedge risk. If you are finding this breakdown helpful, smash the like button, subscribe to the channel, and drop a comment telling me, are you personally feeling trade war impact already? Alright, now let's finish this strong with the big picture and where this goes from here. So where this will lead and what to watch. Scenario 1. Quick resolution and return to trade. If negotiations resume and tariffs are rolled back, then cost shocks ease, supply normalizes, growth resumes. Scenario number 2, prolonged stalemate if tariffs persist for 2 years. Canada faces slower growth, higher consumer costs, job risk, weaker housing markets in exposed. That's a heavy outcome. Scenario number 3, escalation. If either side ramps up tariffs aggressively, we could see major supply chain disruption, heavy inflation, recession risk in Canada. The key watch indicators for you: auto and manufacturing job numbers in export towns, consumer inflation rate, especially goods, Canadian dollar value, weaker CAD, imported goods cost more, trade deal announcements or breakdowns, housing market shifts in export heavy regions. If you ignore trade policy, you are ignoring one of the biggest tailwinds or headwinds your wallet has faced in years. Here are my final thoughts. The bottom line is the US-Canada trade war of 2025 isn't just about tariffs and headlines. It's about your money, your job, your cost of living, your investments. Canada is deeply exposed to US trade. When Canada goes into trade shock territory, households pay. Your best move? Stay aware, build resilience. Don't assume all will be fine. Take action now. If you want a follow-up video, I can dive into which Canadian regions will be hit hardest or how to protect your investment portfolio from trade shock risk. If this video helped you, hit subscribe and share with someone who needs to know. I'm Thuc, your money guy, making money simple, smart, and stress-free. See you next time.